please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Focus on the big story of the day, which is essentially the dollar rupee. Sajid Chinoy, Chief India Economist at JP Morgan, is now joining in from the sidelines of this CFA conference. Sajid, thanks very much. Morning. Should we start to worry a little bit? We know your views has been so far is good. The depreciation we've seen is not it's nothing to really worry about. No reason to panic, and there hasn't really been any panic. But as we are closer to 71, what's your sense?
I think we should just understand the global context here, that this is not a rupee-specific move at all. There are two parts to this. I think for most of the last 2 months, you had generalized dollar strength around the world. The dollar was appreciating against the euro, and that meant that most currencies came under pressure. What we're seeing in the last 10 days is something different. The dollar is not strengthened against other developed markets. What you're seeing is that current account deficit countries or emerging markets with current account deficit countries are having to pay a premium. So in fact, the depreciation in other markets, in Turkey, in Argentina, in Brazil, has been much more, but nobody is really immune. India is not immune. Indonesia is not immune. Even the Chinese CNY has depreciated a little bit. So this is a global move, and when you have these global moves, there is very little that one can do. I think what central banks can do is smooth the move, use your buffer stocks of FX reserves to smooth the move, and ensure that your macro fundamentals remain strong. Because when the stress settles down, investors tend to become much more discriminating. But I keep emphasizing we should not panic, because this is not India specific. It's happening across all emerging markets, and therefore you just have to weather this phase out.
That said, Sajid, you have in your reports argued that the rupee was overvalued for a better part of the last probably 18 months. Now at 71, is it close to its long-term RER average against those 36 countries according to trade weights?
Lata, I've been very careful to use the word overvaluation, because I think it's more art than science. What I will say is the underlying current account deficit of India has widened meaningfully the last 3-4 years once you strip out oil and gold, and therefore some calibrated depreciation would be desirable and healthy for the economy. I think it's important to keep in mind that the 6% real depreciation in trade-weighted terms that we've had in the first 6 months of the year was healthy. What you're seeing now is India just keeping abreast with other emerging markets. So in a way, if we're moving with other EMs or with trading partners, we're not really, the currency is not really depreciating in trade-weighted terms. What matters really for overvaluation or undervaluation is how are you doing in trade-weighted terms. We saw a 6% decline the first 6 months. The last 3 months were basically flat in trade-weighted terms.
Sajid, morning. So, if the 6% was, as you said, perhaps healthy depreciation, something that the economy needed, and now this move is more global in nature because nobody wants to sort of be close to currencies where economies have high current account deficits, then is this now the time perhaps for the central bank to start thinking, start using some of that ammunition that it has in its war chest? Therefore, I'm asking you whether there is sort of a level or maybe another couple of percentage points that you can tell us beyond which perhaps it'll be time to step in.
Well, two things to point out. One is the central bank has been stepping in. Our sense is there's been intervention all the way through. Some days more, some days less, depending on what the underlying flows are. But I think it's dangerous to target levels. I think in this environment, no central bank can artificially target a bilateral level against the dollar. I think economically that doesn't make very much sense, and that's not sustainable. I think once markets sense that you're drawing hard lines in the sand, these things are never sustained for more than a period of time. I think what's important, however, for central banks around the world is to allow two-sided volatility, so that if, once the stress abates and there are pressures for emerging market currencies to appreciate, that the rupee also be allowed to appreciate some amount, so that we don't get into this mindset of relentless depreciation, because that can become self-fulfilling like we saw in 2013. So I guess our sense is, allow two-sided volatility, which the central bank has been doing, and use reserves judiciously, given that this could be a prolonged fight for many months and quarters.
Okay. Well, I want two more quick questions to be squeezed in before you are taken away by your conference guys. One, later today is the big number, the GDP number. Our poll said 7.7% on GBA. What is your number? And what would you watch out for other than the GBA number?
Yes, Lata, we're in the kind of 7.5-ish range. Okay. Here's what I will say, that today is a healthy number. I think it confirms that we've had a nice cyclical recovery in the last few quarters. It will kind of soothe the nerves given all the stress around the world. But let's also accept that there are a lot of large favorable base effects that will push these numbers up. My sense is as the year goes on and those favorable base effects fade, growth on a year-on-year basis will kind of moderate. And again, that should not be alarmist, because just as for statistical reasons this number is low, you may get the opposite phenomenon in the coming quarters. What I would look for is to look at what we say is core GVA, that if you take out government spending, if you take out agriculture, what is the private sector momentum doing? What we've seen in the last few months is there's this divergence opening up, where the services sector is doing well, but industry, because exports have struggled, has struggled a little bit. So I'd be curious to see how industry stacks up vis-a-vis services in the private sector in today's number.
Okay, and finally, Sajid, just as you were speaking, and I think we should play those lines. Mr. Kanungo, the Deputy Governor, is speaking at a meeting, I think CII meet, and he's coming blistering on fiscal deficit. He's pointing out that state fiscal deficits have been repeatedly slipping. That's the RBI's observation. And even the central government only once in last many years had 3% of its fiscal deficit, has its fiscal deficit at 3% of GDP. So, it's coming down pretty heavily on fiscal deficit. And then you have this rupee at 71 and its concomitant impact. We just heard from our reporter that all detergent prices all detergent companies have priced up their products because of higher imports. So now, are you increasing the chances of rate hike in your projections? One rate hike earlier rather than later, or have you made that 1 into 2 rate hikes?
Yes. Two quick reactions, Lata. I think the fiscal deficit is important for 2 reasons. In this very stressful global environment, it'll have a huge psychological impact if India can stick to its deficit. So I think the center should double down, and I'm hoping they will. The second is, think of where the pressures are. The pressures are on current account deficit countries. Ultimately, a current account deficit is investment minus savings. The lower our fiscal deficit, the higher will be our saving, and the lower will be the gap. So it's clear that India cannot finance a 3% of current account deficit in this environment. No country can. So we need to bring that 3% down in the coming quarters. And one key enabling mechanism will be if the center and the states can stick to their fiscal deficit targets. That itself will bring the current account deficit down. In terms of monetary policy, there are offsetting forces here. With rupee depreciation, there will be passed through into inflation, and that the MPC will have to worry about. That said, food prices seasonally are very weak. And my sense is we don't have all the data as yet, but when the August CPI comes out in September, remember, because of base effects, that was going to fall to 4%, and it's tracking below 4%. So we could be in a situation where CPI for August prints at 3.7 or 3.8. So the RBI is going to have these conflicting pressures where it goes into the October meeting with CPI declining, core momentum has come down, food prices are soft, but at the same time you have to look forward, not back. And against softer food prices is the fact that a weakening currency will impart some price pressures as well. So it's going to be a delicate balancing act. We currently have one rate hike in our baseline, but I think in this environment, 25 to 50 basis points for the rest of the fiscal year is what we're working with.
Sajid, just one quick last question from my side. One particular subject which has been addressed quite a bit by many in the recent past is this trend of falling net household savings, which we are seeing, and how this could become a concern going forward. I mean, have you sort of done any work on this? What are we looking at? Should we focus on the percentage to begin with? Shouldn't we look at the absolute numbers? I mean, what's the right way to look at it?
Well, so I think, number one, these numbers bounce around a lot, so we shouldn't overinterpret 1 or 2 prints. But I think the larger point is the following, that savings are very pro-cyclical. And to the extent that in the last year, growth actually slowed, I'm not surprised that private savings, household savings would fall, because that's what happens. When you get negative growth, income shocks, savings follow that because you want to smooth consumption across time. So to the extent that GDP is forecasted to accelerate this year, and given the pro-cyclicality of savings, I would argue that private household savings will pick up over time. But I just want to come back to the centrality of this, given the external imbalances, which are the key constraint for emerging markets. Remember, the current account is investment minus savings. We don't want lower investment. We want higher investment. Household savings should hopefully pick up a little bit, but that needs to be complemented by lower government dis-saving and keeping the fiscal consolidation on track.